The list of new DeFi blockchain projects is continuously expanding. In this sea of choice, which projects will be tomorrow's stars and worth investing in? In this video, I'll detail a list of performance indicators used to estimate a DeFi project's investment potential. Some of these indicators overlap with the metrics one would look at when evaluating traditional stocks. However, given the very different nature of crypto investing, many of these indicators are more relevant to the crypto world. In fact, these indicators are specifically applicable to DeFi project tokens, rather than to blockchain projects of other types. And before we start, don't forget to like, subscribe, follow, and share this video. Also, if you have something interesting to say it in the comments with your Phemex UID, and for the top 3 best comments, we'll send a $15 trading bonus to your Phemex account. Let's get started. The first one we'll look at is price to sales ratio. The PS ratio is a fundamental KPI in the world of DeFi. It's calculated by dividing the token's fully diluted market capitalization by its 12-month revenue. In the case of DeFi, the revenue is earned from transaction fees and includes fees retained by the protocol as well as fees earned by token holders and liquidity pool providers. In traditional stock investing, a PS ratio of 1 to 2 is considered good, while a ratio of under 1 is considered excellent. Given the young and rapidly evolving nature of the DeFi industry, these traditional rules of thumb may not be very applicable. Instead, the best use of the PS ratio is to evaluate a number of DeFi tokens on this metric for a comparative analysis. With the comparative approach, you may use revenues for time periods other than the normally applied 12-month period. However, the shorter periods may not be as reliable as the default 12-month period and are often only a trade-off measure due to the need to evaluate newer tokens. Now let's look at the total value locked. The TVL refers to the total sum of all funds dedicated as collateral to the DeFi project. It includes the funds locked in liquidity pools as well as the loan collaterals. TVL should not be confused with the protocol's market cap. Market cap refers to the total supply of the coin multiplied by its current price. On the other hand, TVL refers to the value locked in smart contracts on the platform. For example, in the case of MakerDAO, one of the largest DeFi protocols, TVL refers to the amount of funds held as loan collateral in the vaults of the platform. In the case of distributed exchanges, TVL normally refers to the total value locked in liquidity pools. Larger TVL values indicate a more actively used protocol. Now let's look at the TVL ratio. TVL by itself is a great measure of a protocol's popularity. However, by concentrating on this metric alone, you may miss out on smaller but still promising DeFi projects. The TVL ratio is a measure derived by dividing the market cap of a token by its TVL. This indicator helps you identify smaller DeFi platforms that are performing well and potentially promising from an investment point of view. A smaller TVL ratio is often preferable. It indicates a protocol that might be undervalued and worth investing in. Then we have annual yield from staking. Liquidity pool staking on DeFi platforms can be a viable way to earn investment income. The DeFi protocols can vary enormously by the yields they provide. Looking at the yield provided by the LP staking is an important indicator to track. Given the volatility of many DeFi protocols, it's best to look at the annual rather than the short-term yields. Naturally, as the popularity of protocols rise, yields are likely to decrease. The best yields are often found among smaller but confidently growing projects. Thus, annual yield can be a great way to find promising and currently undervalued DeFi tokens. Next is token supply on centralized exchanges. So while DeFi tokens are all about decentralization, paying attention to the total supply of tokens on centralized exchanges is useful for investment analysis. A large amount of tokens held at centralized exchanges may indicate a potential large-scale sell-off. Such sell-offs often result in the destabilization of the token. Therefore, watching out for these signs is an important due diligence step in your analysis. I should stress that a large supply on centralized exchanges is not necessarily a guaranteed whale action waiting to happen. Using token supply as an indicator should only be part of your research into the token, along with the other metrics discussed in this video. Then we should also look at token movements on decentralized exchanges. So in addition to watching out for the supply, it pays to research recent token balance movements as this metric can provide additional intelligence into potential whale action in the making. Looking at recent movements of the token may uncover substantial withdrawals with the purpose of holding on to large amounts of the token. Such large-scale actions may also indicate a future whale action that might negatively affect the token's stability or supply. While both the token balances and the token movements are useful metrics, it's important to keep them in perspective. Frequently, movements of tokens from exchange accounts to personal wallets and vice versa is a normal practice in the world of crypto trading. Only a very substantial and highly uncharacteristic movement might indicate a period of future instability for the token. Next, we can look at the unique address growth rate. This is a useful indicator measured by the change rate in unique address counts for the token. If the unique address count shows signs of rapid growth, it could point to the project quickly increasing in popularity. Naturally, you need to take into account that this metric is open to manipulation. A small group of people may create a large number of addresses within a short time period to give an impression of the project's popularity. Therefore, again, use this metrics only along with the others to evaluate a potential DeFi project. Now we come to inflation rate. Many DeFi protocols enact rules to ensure that their token supply will not lead to inflation and devaluation of the token. However, not all tokens are protected from devaluation by the platform rules. In some cases, the mechanism behind maintaining a limited supply of the token is unclear, or not even coherently specified by the project. When researching a DeFi project, it's important to look at the token's increase in supply and inflation rate. Tokens with a tendency to demonstrate high inflation rates in the past may be best to avoid. Finally, we come to project documentation completeness. So perhaps due to the mostly unregulated nature of DeFi, many projects with poorly documented details of their protocols have been launched. When evaluating a DeFi project, a key indicator is the level of detail about the protocol provided to the public and potential investors. As a minimum, a project should have a white paper explaining the protocol's processes and tokenomics in detail. The governance mechanism and voting rights afforded to the token holders should also be clearly outlined. For example, what happens if your funds are lost by the protocol due to a security breach? Are you compensated? Do you have to wait for the platform users to vote on a potential compensation for you? Pay attention to these key details while looking through the project's white paper, website, and social media accounts. Though not a financial or operational metric, the completeness of a project's documentation is a vital indicator to take into consideration. All right, so to recap, researching an investment-worthy DeFi project may involve looking at a myriad of factors. However, the indicators outlined here should serve as the core set that you focus on. Among the covered indicators, the key ones are the PS ratio, TVL, and TVL ratio. However, disregarding the other indicators and only concentrating on these three may lead to missing out on important pieces of intelligence. For example, even the best PS and TVL ratio numbers will not give you an indication of a possible whale action with a potential to destabilize the token. You may only get a sense of such a scenario by looking at the token supply and the token balance movements on centralized exchanges. In addition to the financial and operational indicators, take into account the DeFi project's clarity and completeness of documentation. Even the best performing protocol may not be worth the risk of investing in if your rights as a token holder are not clearly specified, or you're not certain about the process of earning the LP staking interest. All right, that's all for today. Thanks for watching. See you next time.